Hello, this is Eamon Verdone, a member of Savant's investment research team, here with a review of the markets during the first quarter of 2016. The first quarter was a bit of a roller coaster ride, but ended with positive returns for U.S. and emerging market stocks, while international developed stocks fell slightly. U.S. and foreign bonds both produced positive returns during the first quarter. All three alternative asset classes were up modestly during the first quarter, led by global real estate. Unemployment stayed steady at 5.0% after dipping to 4.9% intra-quarter. This steady number marks a slight improvement as more Americans re-entered the workforce, seen in a higher labor force participation rate. Inflation rose to 1.0% year over year, which is improving but still shy of the Fed's 2% target. On the economic growth front, U.S. GDP slowed to 1.4% as the global economy stumbled in the later stages of last year. Many investors flocked to safer assets, driving the 10-year Treasury yield down 0.5% to 1.8%. Later in this presentation, we will show the benefit this had on bond returns. Stocks worldwide tumbled to start the year. In fact, this was the worst 10-day start of all time for U.S. stocks. Early in February, crude oil began its rally from a low of $26 a barrel to end the quarter near $37 a barrel. And on Super Tuesday, Donald Trump and Hillary Clinton strengthened their early election leads as the market improved due to strong economic data and recovering commodity prices. After briefly entering correction territory, the S&P 500 rallied to return just over 1% during the first quarter. Value stocks had a strong quarter, outperforming core and growth stocks among both large and small market capitalizations. Despite an erratic quarter, U.S. stocks continued to have high single-digit to double-digit performance over the past 5 years. International large-cap stocks fell short of making up losses from their January sell-off. However, international small-cap stocks fared slightly better, as international small-value stocks even posted a minimal gain on the quarter. Right on cue with the surge in U.S. stocks, international developed stock asset classes all returned between 6.5 and 8.5% during the month of March. Emerging market stocks were not excluded from the rough start to 2016, but a return of over 13% in March springboarded emerging markets to a strong 6% return for the quarter. Small-cap emerging market stocks did not recover with the same vigor, but did manage a positive return of 1% during the quarter. Short-term returns are still negative, but it appears as if the worst may be behind us in regards to emerging market stocks. Switching our focus to bonds, inflation-adjusted bonds led the way with a 4.5% quarterly return, driven by the increase in inflation. With a return of 4.3%, foreign bonds continued their recent streak of solid returns. Short-term and intermediate-term bonds also had positive returns as investors fled to safer assets and drove the Treasury yield lower by 50 basis points. Once again, global REITs were the strongest alternative, returning over 7% this quarter. Slightly higher, and equally important, stable, crude oil prices, along with the rally in precious metals, manufactured a positive quarter for commodities. Managed futures provided downside protection for portfolios during the early correction in equities on its way to a return of nearly 5% during the first quarter. Next, let's look at the asset class returns together. The portfolios on this slide illustrate the hypothetical performance of different global stock and bond mixes of indices. As shown in the bottom left corner, the hypothetical investor with 100% bonds would have fared the best during this past quarter. However, more diversified portfolios, including allocations to emerging markets and alternatives, performed even better during the first quarter. While larger allocations to stocks have more risk and volatility in the short run, they have higher expected returns over time. The growth of $10,000 chart illustrates this well, as each riskier portfolio has provided a greater return on the initial investment. The Great Recession may seem like yesterday, but the bull market has officially lasted 7 years as of March 9th. Already during this bull market, unemployment has been cut nearly in half, and U.S. GDP has risen by $1.9 trillion to a total of $16.4 trillion. Before you worry that this bull market may end soon, we need to realize that historically, the average bull market has lasted just over 9 years. In fact, half of the 8 bull markets since 1926 have lasted more than 10 years, so don't count this bull out just yet. Looking at the S&P 500's cumulative return, there have been more than a few bumps along the way, but investors who held on were rewarded with a 254% return through the end of this past quarter. While we cannot prudently predict what will happen, we certainly hope strengthening economic signals will keep this bull market around for at least a few more birthday celebrations. The media often publishes scary stories to garner clicks, but the truth is, the U.S. economy is showing signs of getting stronger. Over the past year, unemployment has fallen, the labor force participation rate has risen, and wage growth has improved. Progress among these statistics is a key driver in pushing the U.S. economy into an expansion stage. While international developed and emerging market stocks have not kept pace with the U.S. stocks in recent years, they still have very attractive valuations. This leads to higher forward-looking returns among international stocks that should benefit well-diversified investors. On a portfolio level, Savant is continuing to actively rebalance and tax-loss harvest portfolios during corrections, rallies, and everything in between. We also continue to review all current and potential investment opportunities to further optimize your portfolio. That wraps up the first quarter of 2016. Thanks for listening.